Today, we're going to dive into a pressing issue that's been causing widespread concern: China's debt problem and how it's going to be a pain for the global economy. We're going to uncover the potential ramifications of this debt mountain on China's stability and the global economic landscape. In this video, we'll dissect the contrasting perspectives surrounding China's debt problem, exploring whether it represents a genuine threat to both China's stability and the overall health of the world economy. Get ready to navigate the intricate terrain of China's debt problem. Stay tuned to learn how China's debt problem could disrupt the global economy. Hit the subscribe button and turn on notifications to never miss an update.
It's hard to see a recovery anytime soon.
Now, despite being a major creditor to other nations, China itself grapples with substantial debt levels. With both public and corporate debt, China ranks among the most indebted large economies globally. The state-owned banks, especially in the real estate sector, face significant challenges with bad debts and non-performing loans. However, the visible debt is only the tip of the iceberg, as there exists a complex web of off-balance sheet lending, wealth management products, and local government funding vehicles. This hidden debt surpasses the apparent figures and raises concerns among analysts about its potential to destabilize the global economy. Western nations also worry about the implications of China's ascent in global affairs. Also, Wuhan, China's largest city, is facing a severe debt crisis as 259 companies and entities are urged to repay over $14 million in combined debt. This reflects the wider problem of mounting government debts in China, worsened by pandemic control costs and a real estate crash. Kunming, Yunnan, and other cities and provinces are also struggling with debt obligations. There's no doubt that China needs to address fiscal challenges and find sustainable solutions to mitigate risks from high debt levels. A background of China's debt. The release of China's first quarter GDP figures last year ignited discussions on whether the country can meet its 5.5% growth target for that year. The International Monetary Fund also revised its GDP growth forecast for China, further raising doubts about achieving even the lower projection. However, it's important to note that China's GDP growth shouldn't be solely regarded as a measure of economic performance, unlike in other major economies. China's GDP growth target is set by the government at the beginning of each year and depends on the authorities' willingness to utilize resources and debt capacity to stimulate economic activity. Higher GDP growth in China doesn't necessarily indicate a better economic outcome, as it primarily reflects the authorities' commitment to allocating resources to generate economic activity, regardless of its productivity or sustainability. Therefore, GDP growth alone doesn't provide a comprehensive assessment of China's economic system. An output measure is needed for a more accurate evaluation. What truly matters is how China achieves its growth, regardless of the specific level. President Xi Jinping has emphasized the importance of high-quality growth over other types, emphasizing sustainability, efficiency, and genuine process. Genuine growth entails sustainable expansion driven by consumption, exports, and productive business investment, while inflated growth primarily stems from non-productive or inadequately productive investment in infrastructure and real estate. Inflated growth is aimed at bridging the gap between genuine growth and the politically motivated GDP growth target established by the Chinese leadership. Consequently, a better economic outcome for China involves promoting genuine growth while reducing inflated growth. Conversely, a worse outcome would involve a higher reliance on inflated growth and a lower emphasis on genuine progress. The achievement of a GDP growth target exceeding the underlying genuine growth merely indicates Beijing's determination to reach a particular level of economic activity, the willingness to take on debt, and the resources devoted to achieving a politically acceptable GDP level. Hence, the GDP target alone doesn't offer a comprehensive measure of the economy's overall health. Although the increase in debt itself doesn't necessarily pose an immediate problem, a significant portion of China's debt is channeled into investment activities. Consequently, the country's debt-to-GDP ratio serves as a reasonable proxy for the extent of inflated growth in China's GDP figures. For instance, in 2020, the COVID-19 pandemic led to a decline in consumption, causing a contraction in genuine growth, while a surge in investment in infrastructure and property explained more than 100% of China's GDP growth. Consequently, China's official debt-to-GDP ratio increased to close to 279.7%. To get a better understanding of how crazy this is, the U.S.'s debt-to-GDP ratio is just around 127%, with the only country coming close to China's debt-to-GDP ratio being Japan, with 264%. However, in 2021, there was a reversal in consumption, accompanied by increased exports and business investment. Concurrently, Beijing implemented measures to control the property sector and restrict growth in infrastructure investment. As a result, the growth observed in 2021 was primarily genuine growth, and China's debt-to-GDP ratio remained stable. This underscores the overdependence of China's economy on non-productive investments in property and infrastructure to offset the country's high savings rate and bridge the gap between genuine growth and the GDP growth target. The Belt and Road Initiative, or BRI, also played a key role in China's current debt crisis, as China emerged as the world's leading official creditor by dumping over $1 trillion in loans at high interest rates to approximately 150 developing and least developed countries through the BRI. Initially proposed by President Xi Jinping in 2013, the extensive array of development and investment projects aimed to connect East Asia and Europe through the establishment of physical infrastructure. However, things didn't go as planned, as borrowing nations grapple with foreign exchange crises and struggle to pay their debts. Around 60% of China's overseas loans are held by financially distressed countries, marking a substantial increase from a mere 5% in 2010. Recent examples, including Pakistan and Sri Lanka, illustrate the precarious situation for China. Sri Lanka's economy recently collapsed amid ongoing political instability, while Pakistan faces the imminent threat of an economic collapse. Both countries find themselves unable to repay their loans, posing a considerable risk to China's economy. To properly understand the background of China's debt, it's imperative to consider the significance of genuine growth and the risks associated with inflated growth when discussing China's ability to achieve its GDP growth target. The surge in China's $51.9 trillion debt burden reflects the economy's heavy reliance on non-productive investments. Understanding the composition and implications of China's debt is crucial in evaluating the overall health and sustainability of its economy. The impact on the global economy. China's remarkable economic ascent appears to be encountering hurdles, prompting concerns about its impact on the global stage. The repercussions of China's slowdown are anticipated to be felt by both developing and developed nations. In the developing world, countries reliant on China as a crucial market for their natural resources or as a source of vital aid now face uncertain times. The economic difficulties experienced by borrowing nations have made it increasingly challenging for them to repay their debts to China. This trend is particularly worrisome as a significant portion of China's overseas loans are held by countries facing financial distress. Recent examples, such as Pakistan and Sri Lanka, highlight the precarious situation. Sri Lanka's economy has suffered a significant setback, while Pakistan teeters on the edge of an economic collapse. Both countries are grappling with the challenges of repaying their loans, posing risks not only to their stability, but also to the Chinese economy. The consequences of China's economic struggles extend beyond its immediate trading partners. The United States and other developed countries also face potential setbacks, particularly for individuals and companies heavily invested in Chinese stocks and businesses. The interconnectedness of the global economy means that any disruption in China will certainly have far-reaching effects. However, amid the concerns lie prospects for a positive change. A significant economic downturn in China could accelerate the relocation of foreign companies from the country, leading to a reconfiguration of global supply chains. Nations like Vietnam, India, and Indonesia stand to benefit as they welcome these companies seeking new manufacturing bases. While this shift holds promises for the future, it will take time for the full benefits to materialize. Nevertheless, the immediate impact of a Chinese economic falter is likely to be felt worldwide. Slower exports, reduced demand for imports, and challenges faced by companies operating within China's borders will present obstacles to global economic growth. The repercussions reach industries such as construction and energy, affecting not only China, but also countries dependent on these sectors. The intricate web of investments further complicates the situation. Investors with significant stakes in Chinese companies listed on American exchanges, as well as holders of China's foreign currency debt, face inherent risks. Additionally, the ambitious Belt and Road Initiative, encompassing numerous infrastructure projects across the globe, confronts uncertainties as financial strains mount. As it unfolds, the global community keeps a watchful eye on China's economic trajectory, mindful of the potential ramifications. Balancing the immediate challenges with the prospects for long-term shifts, the world seeks stability and a sustainable path forward for both China and the global economy. Mitigation measures and policy responses. In an insightful article by Michael Pettis from Carnegie, He explores the various paths China could embark upon to tackle its debt predicament and minimize its negative repercussions. As we delve into these potential trajectories, we witness the intricate decisions that lie ahead for China's economy. One possible route involves maintaining the status quo, allowing non-productive investment to persist as a primary catalyst for economic growth. However, this perpetuates the mounting debt burden, potentially leading to long-term ramifications. Alternatively, China could choose a path of transition, reducing its reliance on non-productive investment and embracing productive investment, such as technological advancements. By doing so, China aims to foster innovation and nurture industries that can sustainably drive economic growth. Another avenue involves curbing non-productive investment and prioritizing domestic consumption. By stimulating domestic demand, China strives to achieve a more balanced and sustainable growth model, ultimately reducing its dependence on debt-driven investment. China also has the option to pursue a path focused on bolstering its trade surplus. Through efforts to enhance export capabilities and reduce imports, China aims to strengthen its external trade position, generating additional revenue that could alleviate the burden of debt. Lastly, a path of reduced non-productive investment without a clear replacement strategy could lead to an unavoidable slowdown in growth. This scenario necessitates careful adjustments as the economy adapts to a new landscape. The significance of these paths lie in the choices China must make to address its debt issue and steer towards a more sustainable economic trajectory. Each path presents its own set of implications and trade-offs, underscoring the need for thoughtful deliberation and effective policy implementation to ensure long-term stability and mitigate risks associated with the mounting debt burden. China's debt problem poses challenges for its economy and the global economy. The scale of debt and associated risks raise concerns for financial stability and global trading partners. Mitigating the issue requires thoughtful policies and sustainable growth models. Monitoring China's efforts is crucial for long-term stability and global implications. Subscribe now to our channel for more insights on geopolitical issues. Stay informed and join the conversation.